Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Seth Cogswell, founder and managing partner at Running Oak Capital, to discuss the Running Oak Efficient ETF and how it fits within client portfolios. Seth, it's great to have you with us. Welcome to Trade Talks.
Thank you.
You got it. You got it. Let's talk more about RUNN. Why should people invest in
it? Quite honestly, because it's obvious. I believe that if people just take a moment and contemplate what it is that we do and how we invest relative to our peers, I think it's clear that it's very likely to add value. We are inundated with statistics all day, every day, and really that's just the result, a natural result of the investment philosophy. But first and foremost, what matters most is the investment philosophy. And our philosophy is very simple. It's easy to understand, and it's common sense. Most simply, our process or Run's philosophy enables clients to easily invest in qualities that are clearly desirable, such as profitability, because making money is a good thing, or higher earnings growth, because making more and more money is an even better thing, or investing in under to fairly valued companies, because getting a good price for an asset is essential to getting a good return. On the flip side, Run enables clients to avoid the landmines that are out there, such as, again, unprofitability, overvaluation. There's arguably some of the most widely held companies, their valuations rivaled the tech bubble. So really being disciplined around that. Insolvency, because there's now more debt on corporate balance sheets than any time in history. And interest rates just rose more than any time, or faster than any time in history, which is not going to be a good thing. And it also helps guard against irrational portfolio construction. For instance, the S&P 500 or index funds, right now, a small number of companies represent roughly 30% of those portfolios. And those companies are highly correlated. So you might as well have a third of your portfolio in 1 to 2 companies, which no sane person would ever do. So again, it's really just the simplicity of our strategy. I believe when people really take a step back and think about it, is clear and is likely to provide value.
Okay, so Seth, let me open a page here, the fact sheet, right? What's the 1 or 2 liner? What's the purpose behind Run? What's the methodology behind it?
The methodology, it's rules based, so it's really designed to be very disciplined, repeatable, dependable, and unemotional. So right now, emotions are running hot, and it's designed to be unemotional. But again, it's really designed to, with discipline, guide the process around those traits that we seek to invest in. So again, profitability, higher earnings growth, attractive valuations, lower downside risk.
Are there any other reasons why Run is particularly timely in today's market environment?
Yeah, there's a couple of significant dynamics going on right now. One of which is the discount in high quality companies. So according to a number of metrics, high quality companies, which are basically just profitable companies with reasonable amounts of debt, they are arguably as cheap as they've ever been relative to the market. So precisely the type of company we would all say we want to invest in are a steal right now relative to history. And meanwhile, due to the construction of, let's say, index funds, the cap weighted structure means that as companies become more overvalued, they become a larger percentage of the portfolio. And if they become less more undervalued, they become a smaller percentage. And so if high quality companies, again, just companies that make money and are unlikely to go bankrupt, if those are the cheapest that they've been relative to the market, then people have very little invested in exactly what we would say we want to invest in. And then they have a lot invested in the opposite. Sorry, go ahead.
No, go ahead, finish your thought.
I was just going to touch on really quickly, another dynamic is the somewhat, again, historic discount mid-cap stocks. Mid-cap stocks generally trade at a premium to large cap stocks because they're more dynamic. But they're currently trading at a discount that hasn't been seen since 1999. our portfolio is 55% invested in mid-cap stocks right now, and our starting point is high quality. So if those two, kind of structural inefficiencies right now just simply revert to their very long-term mean, that could mean a very significant tailwind for Run.
And finally, how does Run fit within a client portfolio?
Run walks the line between growth and value, mid and large. It's really meant to be sort of that central kind of core component to a client's portfolio. I always like to think of metaphors just sort of to help us wrap our mind around things. But if you think of an overall equity portfolio as an ice cream sundae, Run is really meant to be that vanilla ice cream. It's the central piece. Arguably maybe even a little bit of boring, but it's meant to be that piece that helps you sleep better at night. And then you can complement it with other things such as, say, NVIDIA or Microsoft, which given their valuations would never be a part of our portfolio right now, but are obviously great companies and, could be a good piece. But and then on the other side, you've got, say, dividend income or small cap and international. But again, it's really meant to be that sort of main piece that you can, rely upon.
All right, Seth, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.